So, hi everybody, Dan Weisskopf, otherwise known as the ETF professor and member of the Taroso Investment Committee and company. And here we are, the ETF Think Tank. Welcome. And for that, I would say it's a happy hour, Thursday. David, you're up, and I'm going to continue to let people in.
How's it going, everyone? David Chikansky here. We'll keep it very brief. Portfolio manager here with Taroso Investments, cover a number of ETFs and our SMAs, and very excited to talk all things alternative in today's conversation. Cynthia, you're next.
Hey, everybody. Cynthia, I'm head of research for the tank, and always my favorite hour of the week. So thanks for joining us. And thanks, everybody who's turning on your videos. We love to see you face to face. So we love when you turn it on. Mike, good to have you back.
Yeah, I've been traveling a little bit. I love that you used the Brazilian pronunciation today. I have not heard you say Cynthia before.
Yeah, sorry. Cynthia is my stage name.
That's your stage name. Well, it's funny because Laura Krager at Vetify once said to me, "Oh, is Cynthia going to be there?" I was like, "Who the hell is Cynthia?" And then you told me, "Oh, that's how you pronounce it in Portuguese, I assume."
Yeah.
Is that? Yeah.
Yep.
Okay, so happy to be back, folks. I'm Mike Venuto. I'm the founder of this. My title for this show is Chief Cat Herder, but I've given it over to Mr. Weisskopf today. So excited to see a lot of our friends here, and excited to have Shana join us. She's got some great news about what's going on with her career and her new business. So I guess I'll just kick it to her to tell us a little bit about yourself.
Sure.
Or as much as you want.
All right. My name is Shana Sissel. I am the founder and president of Banrian Capital Management. Our goal is to help advisors find ways to put alternative investments into their clients' portfolio in a way that's scalable, manageable, and help them through the process. So both liquid and illiquid. I believe everybody should have alternatives in their portfolio, and we can talk about that. I've been in the business for 21 years, almost 22 at this point. Had lots of different jobs, but most people know me because I'm on TV a lot. And so I'm CNBC, Bloomberg. I'm doing TD Ameritrade tomorrow, TD Ameritrade Network, Fox Business. So people tend to know me because they see my face on their TV screen pretty regularly. So that's just a little bit about me. I mean, we can go further if you want. I'd love to talk, at least to start off, a little bit about Banrian and what I'm doing, because I'm super excited about it. I was just joking before we went live that, starting your own business, and I am a very reluctant entrepreneur, like it's very not my thing. But starting your own business is super scary, and I'm doing it more out of like survival than anything else. So I've had moments where I'm like, what am I doing? Like, I can't do this. And 2 weeks ago, it's probably there. But since then, I've had some good stuff happen. And I just signed a strategic partnership that I'm really excited about. And so I'd love to talk about that. And
why don't we just start there? So first off is, what is your new venture? Because like you said, everybody recognizes you, but we need to know what you're doing today. And who is the new partnership with, and what is it going to be? And I think we can broaden it out from there.
Yeah, so I started Banrian Capital Management in the end of last year. I was working for a firm called Spotlight Asset Group. I was their chief investment officer. It was a very awesome place to work, but there was some operational issues, and unfortunately, most of the staff at the firm had to be let go. And so at the time, I started Banrian because I was getting asked to speak at a lot of conferences, and I wanted to be able to invoice for speaking fees. And I wanted to have a tax efficient and way to do that, because I didn't want to have to also try to manage my taxes with all these weird 1099s. So that's why I started Banrian, and it sort of evolved from there. I was doing some consulting work with a firm called Armada ETFs, which many people here know well because they work with Title Taroso. And Taroso helped them launch their first product, which is their house ETF. And so I was really part of the team from the beginning, helping them with the launch of the product and helping them, get it up and running, distribution strategy, all that good stuff. So it was pretty exciting. And just have had a lot of volatility and trying to find the right spot. And so I've sort of decided to lean into Banrian because I could. And so one of the things I've been able to do and I'm super excited about is just this week, I signed an agreement for a strategic partnership with a firm called Third Wire Asset Management, which is also Chicago based. And it's such a tremendous partnership because our vision and our philosophy and alternatives completely align. So I spend a lot of time working with advisors talking about how to put alternatives in portfolios. And I get very frustrated with the landscape because I don't think most people, especially most advisors, really think about alternatives in the way they think about putting a fixed income portfolio together or putting together an equity portfolio. They kind of think of alts as like one-off things they put in with clients as a diversifier or a tactical decision, but they don't really think about making alts a core part of their asset allocation. And more importantly, just like they would build fixed income or equity, building portfolios that within that subcategory diversify each other. And so what Third Wire does is they provide turnkey solutions for advisors to use, accredited investors, but their products are a fully diversified, risk managed portfolio that you can literally just plug and play into what would be your core alternative allocation. And that's how I think you should approach alts. Their products are great. They have a great track record. They're well diversified across the board in the different underlying strategies. They have a good track record. And so I really like the team. I would use the product and I recommend the product because it solves very easily this problem that I think is out there. And it's very easy for advisors to use. So I'm really excited about the opportunity to work with them and to have advisors that work with Banrian have access to these products as a core part of their asset allocation solutions to alternatives.
I know, David, do you want to jump in? Otherwise, I was going to just quickly ask, is the problem with alternatives the way advisors approach it? Is it because alternatives are for diversification? People see them as for diversification only, not for outperformance, and it's a lot more exciting to chase outperformance than just diversification for diversification's sake.
I actually don't even
we were talking earlier, but you were saying how this whole category is very misunderstood in the advisory space. So why is that?
I actually don't think advisors think about alts as a diversifier in the core sense. I think they think of it more as a tactical diversifier, and they don't see the alternatives as a core diversifier the way you would fixed income. So everybody and their mother in the last year wants to talk about the death of the 60-40, or as I like to call it, the evolution of the 60-40. Because all of a sudden people are starting to realize like, whoa, fixed income and equity can both do really bad at the same time. And I laugh because I've been implementing alts in portfolios for years now. And the people I work with that use my portfolios don't have this problem because my alts sleeve is outperformed all year. And so I look at it as, yes, there's some semblance of it's wanting to chase. And the reason why I don't think alternatives, especially in the last 10 years, have really caught on as like this core aspect is because in a rising bull market where equities outperform and rates are going lower, so fixed income's outperforming, hedged products don't seem very sexy. They don't look that great performance-wise. You kind of look at them and think, why would I want to invest in that? It's underperforming, well, mostly just equities. They tend to do fine compared to fixed income, but because they're complex, it's just easier to go to fixed income as that downside protection, right? But these products and these hedge products, these volatility products, these derivative products, these products that are meant to provide really true diversification because they have no real correlation to bonds or equities. We can talk about the nuances there, but they really do add value. Like, I have done some analysis and I like to share it because it makes the point. Over the last 10 years, if you had a 20% allocation to liquid alternatives, which is the least efficient way to get your exposure. And when I say liquid alternatives, I mean ETFs and mutual funds, not liquid in the sense of like hedge funds that play in liquid markets. I'm talking about actual, the strategy wrapper is liquid. So everybody can have access. If you did that, and again, least efficient way to gain your exposure to alternatives because they are super handcuffed with like regulatory rules on what they can do to implement these strategies. But even if you did that, 20% in a diversified bucket of liquid alts, you would have outperformed a traditional 60-40 portfolio by about 50 basis points on an annualized basis, which whatever, that's not enough that I think people would jump at that. I think 50 basis points annualized over 10 years is a big deal, but the number doesn't look that sexy when you're looking at like 9.86 versus 9.5. But what you do get, and this is the part that's the most important part, is you get a meaningful reduction in the overall risk and volatility of the portfolio, like meaningful, 300 basis points. And again, this is using the least efficient products on the market to gain exposure. The reason I use it though is because they are the products that everybody can access. Whereas even the products that Third Wire offers, those are accredited investor only. The interval funds, a lot of them are accredited investor only. And there's a reason why. Those are better ways to gain access because liquidity limitations in the way these strategies work. And then if you can go fully private, you just have a larger universe to work with, to select from. And so I think that that's a compelling case for why, just like after the tech bubble burst, I don't know how many people, I've been in the business that long. That's when I started. Just like after the tech bubble burst, remember, everybody remembered that the 60-40 was like a thing. And all of a sudden people started talking about how important it was to keep your bonds. And even when markets were going straight up, we all reminded ourselves like bonds are a diversifier. And you never saw that like real move away from fixed income, even as the markets were raging, because we learned a lesson to some extent.
And the difficulty with that then, and also alts now, is that your outperformance comes in these spikes and these spurts, right? Like if you look at like a rolling comparison of returns of the portfolio with an alt sleeve versus a 60-40, the 60-40 probably has greater time outperforming like 60% of the time, 70% of the time, but it's these outperformance from these events when there's high correlation between stocks and bonds that really add to it. And I think alts definitely have been a core of what we do at Taroso on the SMA side for quite some time. Mm-hmm. Every model has at least 2 alt to 20 different alt positions. And I do think like your philosophy of, it seems like you have positions that are, might have volatility in the alt sleeve that you might not necessarily consider alt, but they're kind of divergent or negatively correlated to each other. So that together they have defensive or also return enhancing characteristics. But to then take advantage of the alts, you have to, as you alluded to, keep it through the bad times,
right,
and then rebalance out of it through the good times. So I'm going to ask you the hard question: have you recommended to your clients that they rebalance out of your alt sleeve at any point this year? Because at one point you're up and equities are down 35, and
you're up like 25.
Like, how do you make the call where you're like, guys, I've killed it, here's your money back, right? And I think that's one of the difficulty is in the alt sleeve is the redeployment, and why the ETF wrapper and some of the innovations in the alt side might be preferable to a closed-end interval fund. Lots of loaded questions. Take your pick.
Lots of loaded questions. So I'm going to start by saying that I don't approach a rebalancing any different in alts than I would anything. So I have a philosophy that you rebalance annually. There's like 1,000 studies out there. I can just Google it and probably get you like 50 that show different rebalancing strategies of a diversified portfolio, and they all show that rebalancing too often has no benefit. In fact, can actually harm you because you end up typically selling too soon or adding too soon. So, there's no real benefit, but almost all the research shows that semi-annual and annual rebalancing is like the most efficient way to do it versus just buy and hold. So if I'm going to do an annual rebalancing and it's in June, that's when I'm rebalancing, and just stick with that positioning and focus. And I'm not going to change it because it's alts. And yes, alts have killed it this year, but I just want to point out alts can work even when other things are working. Like, I think Dan and I were just saying this, one of my absolute favorite products ever that I started using in 2018 is a fund called BTAL. And trust me, when BTAL does bad days, it's not great. 2021, I would say, was a bad year for BTAL. But 2019, BTAL did great.
We're a decade into that product. We love it. Huge fans.
Yeah, that fund did great. You just got to know what it's doing, right? So that product in particular really stands out to me because it's very clearly implementing exactly what it says it does, and it's implementing the strategy. It's not trying to replicate a strategy. It's actually just doing it. And it's an easy to understand, like intellectually, product. It goes long, low volatility stocks in the certain like quintile or decile, and it goes short the highest volatility stocks. And so as long as low vol stocks outperform high vol, which historically that is the case, the fund will do well. And even if they're both negative, like if equities are all negative, as long as low vol is less negative than high vol, you get a positive return. And so the only time it does very poorly is when high vol outperforms low vol, which was 2021, when you saw the mass rotation to small caps and energy. And those were high vol names prior to that. And tech was low vol. And so when that shift happened, the fund got killed. But then, you start looking at the quant screens, and then all of a sudden what's low vol and high vol changes. And then you have that shift in momentum. Anytime you have any sort of factor modeling where the factors can change and the buckets can change based on 12 minus 1 kind of momentum, or based on 12 minus 1 kind of calculation, there's going to be a period when that rotation occurs where anything that is trend following in any way will be behind the eight ball.
So Shana, you're using your, we'll say 20% allocation to alternatives
At minimum.
At a minimum, as a way to lower the volatility of your overall portfolio strategy.
Mm-hmm.
Okay. Are you breaking it down to commodities as a percentage of that?
Yes.
Fixed income as another alternative?
Yep.
And equities, because BTAL is clearly lowering your beta to equities.
Yep. So Third Wire does this really well in their portfolios. They have systematic trend, they have CTA, they have global macro, they have multi-strat. It is a diversified bucket of alternative strategies that are diversified against each other and giving you different exposures. So it is a fully diversified portfolio of alternatives, which is why I love the solution, because most advisors don't have the time or energy to go out and do due diligence on 10 different private alternative funds. And the space is huge. And the other problem is most advisors I know just don't have the bandwidth or the support team to do that. So they like having turnkey solutions so they can focus their efforts on doing searches for unique things for specific clients at client requests. But for broad portfolio to have that efficiency across the board, having something turnkey to just kind of plug and play works. So that's what Third Wire does. And that's what I've typically done in the liquid alt space. So the completely liquid, available to anybody, you don't have to be accredited version of what Third Wire is doing for me is equal 5% equal weighted if you're starting at 20%, BTAL, FTGC, which is a commodity fund. It's a First Trust Tactical Commodity Strategy, I think it's what it's called. LMAOX. I remember that strictly because the ticker is funny to me. That is the Brandywine Alternative Credit Fund. So it's long short credit. And then lastly, I can't remember the ticker off the top of my head, but it's the AQR Global Macro Fund. 4, completely well diversified, equally weighted.
What about the stock premium from AQR, the original BTOL? I love that fund.
It's a good fund, but if I'm only going to have, when I'm building a portfolio, I want to have at least a 5% allocation to anything I'm doing. And I just happen to really like BTOL. The other thing I think about when I'm putting these together, especially for advisors, when we're using like ETF and mutual fund product, which they're going to be using with their smaller clients and smaller accounts to get alt exposure, I actually do think about, is this going to be hard for them to explain to a client? Number one reason advisors tend to stay away from alts and sticking with them through a cycle is because, as you were saying earlier, David, you know, they only tend to work at certain points. And when they do work, they work really well. And then when they don't work, they end up being the thing your clients are complaining about constantly. And if you can't explain it and it's too complicated, then this is a conversation you want to avoid at all costs. So you just don't invest. If 70% of your time, you're going to have to, you know, justify having something in the portfolio that is hard to explain and your clients don't get it, then you're just not going to bother. And I think the AQR risk premium product is a little more complex versus BTOL, in my opinion. Plus, is the risk premium product only available in mutual fund form? Because I feel like that's it.
True. Yeah, stock premium only available in mutual fund.
Yeah, so that's the other thing. If I can find an ETF,
they have a high vol. They have a high vol version of it that's like BTOL with volatility, which is cool.
There's a lot of cool products out there. The thing is that like it's really poorly categorized. And so when advisors go to look for alts, there's no like easy way for them to find this stuff. A lot of it's like hidden in other categories. So they don't have any sense of comparison. There's also like this misconception. This is one of the things that actually makes me angry is they're super expensive, right? Number one misconception with alternatives is, oh, they're too expensive. Well, first of all, in the private funds, those 2 and 20 structures, and most of them aren't 2 and 20 anymore, but you know, 2 and 20, there's skin in the game there. Those managers are participating in the returns, and that's a good thing, not a bad thing. On the mutual fund, the ETF side, people don't understand that the regulatory authorities have this like weird rule where they have to calculate into their expense ratio expenses that are not real. So they have to put in interest expense on their margin, and they have to put in some other expenses, which actually are also part of the calculation and the value of the underlying security as part of calculating a NAV. So it's double counted. And so it's not a real expense. It's just an expense that the regulators say they have to break out and put in the expense ratio. So you look at any prospectus for these things, they actually break out those 3 areas and that are their borrowing cost, the interest cost, their cost to short, margin cost, interest cost, those kind of things into like line items and subtract them out. And they can't actually say this is the expense ratio, but like in the prospectus, if you look, it'll actually show you what the real expense ratio is that they can't advertise. And it's always like 150 basis points less than the stated expense ratio. So BTOL, for example's real expense ratio is like 50 bips, but it says it's like 2.5. And so that's a common misconception. Now, yes, even after you do that, a lot of times these products are slightly more expensive, but they should be. When you are doing a long short product or you are using derivatives, there is a slightly higher cost to implementing that strategy.
Absolutely. Let's go to Mike Venuto. He's got a question. I get to call on him. This is kind of fun.
This is fun. All right, so I love the discussion on BTOL. It's one of my favorites. Yeah, I think you and us have gotten it so much press. Like we're the ones, we got Eric Balchunas to look at it years ago, and he's like, "Holy crap!"
I tell the guys over there all the time that they should be paying me commissions. Yeah. I actually sat on a panel once and was talking about BTOL, and then got off stage, and their CEO was like, "We just got a $5 million inflow." Yeah. Like literally while you were talking. And
it's a great idea. And I love the discussion on the fees because they're making 45 bips. They're not allowed to say what their dividend is versus the expense ratio, but they have to write off the one that they have to pay. It's so exactly. It's like alt start the game with one hand tied behind the back. But
exactly.
One of my favorite trades historically has been pairing something like BTOL with one of the inverse VIX products. I used to love ZIV. I don't think that one should have disappeared, but it did. I'm curious where you think about VIX-like products when it comes to liquid alts. Like we have our VIXologist in the screen. I see Jim Carroll there, and I know Rob Emmerich has XVol. He just left.
Yep.
I've got a lot of our family here
My
who
friend
likes
Nancy with
Yes.
Eyeball.
Yep.
Yep.
Yeah, there's a lot. I'm curious what are your thoughts on the various types of ways to use the VIX in the liquid alt space? Because the ones you talked about there, I mean, the VIX really hasn't worked this year, right? Shorting it, going long it didn't really matter. It didn't do anything, right? It's kind of like it's yawning while we're all like sweating, So I'm curious how you think of VIX products, and if there's anything interesting you've seen in that area, or something that needs to exist in that space.
I actually think there are good products. Now, I'm going to go on the record is I don't like inverse products. I'd
Fair.
rather just do the shorting myself, have better control. Plus, a lot of those inverse products, you have to really know how to trade them, or they can blow you up real quick. Most people don't know how to do that. And if you're just an advisor or an investor who just like, I want to just have alts in my portfolio and I don't want to have to worry about like when I own it, the inverse products get really problematic. So, if you're trading actively and you're using them as short-term hedges and things like that, like totally makes sense. But I just don't ever want to be somebody who has to worry about timing anything. That's not what I do well. Tactically, I'm really good at knowing when to make shifts, but like trying to time a trade, that's not my thing. I don't dislike those products. I think, again, just like any alt, that they serve a diversification purpose. I think there's a lot of, if you can go into the private space, just like I was talking about the work that Third Wire does, some of those like systematic trend following and derivative based like macro oriented funds are just vol funds, and they're very similar. The VIX is interesting because I think people don't realize that like it really does have very long-term trends. And when there is a big spike or drop in VIX, it tends to be very short term. So it's hard for me and what I'm comfortable doing playing that game. But I'm super comfortable having a product like iVol in a diversified mix of alternatives. So I start with 20%, but I think 30% is more ideal. And there's a great JP Morgan study on this that shows that like 30 to 35% is actually like the best allocation to alts. So many people just can't get there with the comfort level. But 20%, you get a really good benefit. 30 to 35, you get max benefit. Anything after that, it starts to actually take away from the diversification benefits. So if you're building out a portfolio, I think there's a real opportunity to use some of these VIX products as part of the like more diversified core in a small weighting, because they do tend to have, even though they are volatility products, the VIX is one of those things that has to be traded thoughtfully.
So the one category I was waiting to hear you say that I'm assuming you probably allocate outside of liquid market investments is kind of a true managed futures allocation. You did mention a tactical commodities play. That's obviously on the long side of that, and a global allocation that's still on the long side of that. But managed futures, again, I think one of the things Troso has done really well is push the envelope on what can be done in ETF. You mentioned iVol. We have Pfizer and a couple other products in our trust that really do a good job taking advantage of some of the dislocations in the market. But what are your thoughts on managed futures as an investment as a whole? And I'll give you just my preference of like, I've just ever since March 2020 just got rid of all managed futures that weren't short term and only looked at like the short term, because I just think like you just gotta like get a 15% clip, give it a haircut, sell it, rebalance it, and just wait for that to come again. But I'd love your thoughts on that category.
So I wrote a paper in 2009 called The Benefits of Investing in Alternatives, and I highlighted the 3 key types of alternatives that everyone should have exposure to. Of course, this was based on what, being able to access private markets. And it was, I believe you should have some hedge fund exposure, you should have some private equity, some private debt, and that CTAs needed to be in there, managed futures. I think that they're a great diversifier. Like I said, the product that Third Wire and I have sort of partnered with, and their offerings all include CTAs. And so it is probably the most relevant true diversifier you can put into a portfolio. My bigger issue is in like the true liquid alt space, the ETF mutual fund world. There's not a ton of great CTA offerings, and there's better global macro offerings. And if you look at return patterns of those two buckets of strategies, they do tend to actually perform similarly as far as like trend, because global macro is somewhat using a similar kind of trend approach to, and using derivatives to do that. So I don't dislike them. I actually want to make sure I always have some exposure to those markets. I choose FTGC right now because that's really just leaning into the fact that like inflation is good for commodities. And so CTAs are long, short, and they aren't necessarily taking advantage of just the inflation part. But as a long-term diversifier, I think a CTA managed future kind of strategy should be a core allocation in every alt portfolio.
And what about commodity producers, right? I think we're in an inflection point right now in a lot of different markets where you could actually argue that there's minimal downside and massive upside from commodity producers. This is coming from someone who would always say, you want the commodities, you want the gold, you want the actual asset. But given these discounts and where we are in these markets, it's almost like a lot of these producers on the oil and that gas side are almost priced like, do you opportunistically rotate from the commodities to the producers if you think there's a benefit and still call that alts?
No, I would not call the producers alts. Producers are stocks and they trade like stocks. They're not diversified. They are companies that have balance sheets and cash flow, and they have to deal with, they're not diverse. They like trade in exchanges. If I go to the S&P 500, the producers are in my S&P. Like that's not a diversifier. So I don't consider that at all part of alts. Now, is there times? Yeah, I mean, anybody who follows markets knows that cyclicals work a lot, and often when they work, they kill it. We just saw this, right? But the producers are still just companies, and they have to be evaluated and addressed on the quality of the performance of the actual company and not the commodity at all. Yes, they're impacted by commodities, but consumer stocks are impacted by consumers, and banks are impacted by other things too. At the end of the day, you're going to choose these stocks based on like the quality of the underlying company.
That's a good answer. I give that. Yes.
I saw that. It made me happy.
Yeah. Well, so I've told the story in the past. I don't have a question, but I'm going to tell this quick version of the story. When I first got involved with ETFs, it was in 2005, and it was because the biggest position in our hedge fund was Newmont Mining, and it was going straight down while gold was going straight up. And that was because State Street had launched GLD, and all the hedge funds no longer needed to use gold miners to access gold directly. So the behavior changed. So it's an access thing. Producers tend to be leveraged versions of the underlying commodity. And so I tend to think of them as less efficient ways to get access to the commodity in a normal market. But in a bull market, they're awesome leveraged ways to get access to the commodity. So I'm glad you answered it that way.
And I also feel the same way, because we're going to talk about alts and might as well mention real estate. I feel the same way about REITs. Yeah,
REITs and MLPs. I hate the fact that they put those in the alt bucket. Like, so we have our own security master, and we get data feeds from Bloomberg, from Morningstar, from FactSet, and we throw away the entire alt column because it's like they all disagree. Right? The Morningstar calls REITs and MLPs alts. That's what I was talking about earlier, about like how this is such a poorly categorized thing. It is awful. I mean, it's up there with how ESG is categorized,
Exactly. That's actually one of the biggest problems in the alt space, quite frankly. Yes. It's the biggest issue that people face, is that there's no clear categorization. And here's the thing. You easily could, if like the traditional providers of data looked at alts the same way HFRI does, or Credit Suisse with their, like, why doesn't Morningstar's categories align with HFRI? Please explain that to me. They are categories that have been
doesn't
around
match
for
the
30
12B1
years.
fees. Yeah, it doesn't match the 12B1 fees. That
There's
they
no
were.
reason, yeah, there's no reason you couldn't have global macro, long short equity, long short credit.
Oh, so they have that
CPA as a-
subcategory later, but they you know,
They
it's
did
yeah.
create Morningstar
yeah.
categories, but they are not aligned with HFRI. They
Yeah.
are called different things. Why are we doing this? Like, this was an established thing for decades. And it would be easier for advisors to be able to build portfolios if they were looking at like and like. Then they have to figure out, like in the liquid mutual fund world, ETF world, like what is global macro? Because it's not the same as what it is in the HFRI world. That is a super established category. It's very easy to understand. If they had categories that aligned, I probably wouldn't have as much demand for my time.
Yep.
So
People wouldn't need me.
So Shana, Ray Scheimer has a question for you.
Fire away, Ray.
Yeah, thanks everybody. Shanna, here's a question I put in the chat because I have used liquid alternatives in some of our models as a diversifier, and usually kind of the approach I've taken, and you're right, there are very few that seem to like hit this. Basically what I'm looking for is it doesn't correlate with the primary asset classes in the model. It typically generally makes money on a year-to-year basis, or if it doesn't blow up.
Mhm.
And then it's either understandable, or if it's not understandable, like some of these global macro managed futures, liquid alts, basically to be able to talk to either the PM or sometimes better the risk manager to
Mhm.
find out, what their risk things are, if they've got all these buckets that are doing any other things. Anything you would add to that, or any other thoughts for like core liquid alts you would hold in the portfolio over time?
No, that's how I approach it. The other thing I do is I look to have a bucket of liquid alts that aren't correlated with each other. So the 4 that I mentioned before, which anybody can easily look up on a Bloomberg right now, are completely uncorrelated with each other.
I actually do that as well. So yeah, I left that part out. Yep.
So yeah, like I'm going to find a long short fund, long short equity, or equity market neutral, depending on, I'm generally going to go equity market neutral. Long short is still equity beta. It's just not that much. It's not as much as if you're all in, but equity market neutral is not equity beta. It is legitimately a diversifier. I used to argue when long short actually should just be considered with equities when you're building portfolios, and just deciding whether or not you want to have a short component, because you're still getting equity beta. It's not actually diversifying anything. It's just hedging a little. So I kind of just look for that aspect. And again, I started with the 20%, 5% each, and then I just looked for 5 or 4 funds that were well established, that were not correlated to each other at all, but also very good diversifiers as a whole. And that's where I came to those 4 funds. Some of the problem has been, and this kind of happened when I started building out the portfolio, is the liquid alt space is fickle, right? These funds have historically had trouble gaining assets. So you might find one you like that doesn't stick anywhere else. And then all of a sudden, like, you have this great fund, it's doing exactly what you bought it to do, but because nobody else gets it and nobody else is doing this, they never are able to like get assets to a scale at which they can survive. And all of a sudden you're looking for a new liquid alt fund because that one closed. Or like what happened with the William Blair Global Macro Fund recently, their macro allocation, that fund was around forever. It had a great track record, but the team left, and this is a traditional long only shop. They didn't really have anybody intuitively to replace them. So they shut the fund down. That happens all the time. And that is the major risk in this space when you're dealing in the public market versions of alts, is that for the last, since liquid alts became a thing in 2007, that's when the SEC kind of changed the rules. That if you all remember, that's all of a sudden everybody's talking about 130-30. Well, 130-30 happened because the SEC changed the rules. And that was like the sissy way to get exposure. That was to like shorting. It's beta 1, so it's not really an alternative in any way, shape, or form. But everybody was all excited about 130-30, and all the major long only shops launched their own 130-30 products, and all of them have since closed them. You go try to find a 130/30 fund now. There used to be hundreds of them. Now it was like 4. Because
we got one in our trust that's kicking ass this year.
all right,
so,
good.
Yeah.
But there's only a few now.
Yeah.
There was a point in time when this initially
No,
happened. Everybody and their mother.
We've been doing this 20 years. Nobody ever came to us with a 130/30 or a long short ETF for like 20 years. And then this year we got one that's kicked ass, Elbay. And then we've got one in filing with George Noble that's going to be the same kind of a different angle. But it's amazing how the world has changed so quickly.
But that's my point.
Yeah.
These funds have only existed since the proliferation of liquid alts happened during the financial crisis, 08, 09. And here's what happened. Everybody saw, oh my God, liquid alts, look, they did so well in 08 and 09. Everybody ran into them. And then we entered the biggest, longest bull market in history, and they ran out of them just as quickly. And then nobody could gather assets. So these thousands and thousands of liquid alt funds that all came to market shrunk considerably to a very small world of liquid alts now. And it changes all the time because so many people have a hard time gathering assets. Now, I'm hopeful that because of the last year or so and all this discussion, people are starting to understand the core benefits alternatives, and now they will really start to take hold and people will stick with them, understanding how they work. But yeah, I mean, they launched at exactly the wrong time in history to have any real success. Now, I think people are starting to get it. But the survivors are the ones that are left. And so you have some limitations on what's out there and what you can do.
David, go for it.
I can't even remember what the original question was.
Yeah.
I went off.
I think we're just having fun at this point.
One question, actually, this is relevant to a conversation that Cynthia and I were having earlier today, and we won't name any tickers, but what are your thoughts on, I assume you have similar views on kind of almost like fake alt categories that like kind of try to do too much in one or try to still have a lot of beta to the market. If that's just not really a true alt. But you mentioned products that are really small as a concern. I think one thing I look at for a concern is these semi-fake alternatives that get too big in size. And I think those are definitely areas of risk. So maybe some like covered call strategies. There's some active managers that have gained a lot of assets in those types of strategies as of late. And I just feel like you get to these multi-billion-dollar funds that are like rolling over options and you're kind of leaving yourself out to dry potentially.
There are some really great covered call strategies. Like the gateway strategy is famous because it's in the Markowitz paper about that's the base strategy he used to show that Bernie Madoff was a fraud. He used the gateway strategy. That strategy's been around for a long time. It's just equity to me. Covered call strategies are just equity to me. But to your point, I won't name names, but there is one strategy out there that gathered a lot of assets. It was a LEAP product.
Oh, we're talking about the same product. This is the same product. Cynthia and I were talking
probably
about
thinking
this
of the same
morning.
one that absolutely marketed itself as downside protection and absolutely sucked when this market turned. As a matter of fact, I think it underperforms the market even when the market was down, which is exactly what you would not expect from that strategy at all. I never liked this strategy because I was like, if I want to be diversified and protect myself on downside, this is not how I would do it. But yes, to your point, I think it's especially important. And again, I have a job and people want to talk to me because of this, to understand the complexity of the underlying strategies and be able to spot the ones that aren't really going to help you and do what they say at all. And I'm really lucky because I got started in the alt space in 2007. My very first job in alts was working at the Russell Investments Hedge Fund of Fund, which was quite the experience because I started in July of 2007. And the first week I was there, they were like, one of our ABL, asset-based lending funds is gated and we put in a request for liquidity and we don't know if or when we will ever get it. It was literally like my first week. I don't even know what an asset-based lending strategy was at the time. It was a firm called, I was in Greenwich. It'll come to me when I'm not thinking about it. But it was a pretty famous like ABL fund. And so the first thing they asked me to do was to create a regression model and to try to replicate the exposures, the underlying exposures that were in the fund so that we could hedge it. So that was my very first thing. And then like 2 months later, well, not even 2 months later, that August was when we had that like large cap value meltdown because of all the margin calls on the illiquid stuff. Does everybody remember this? All the large cap value funds like sold off, and everybody was like, what is going on? And it was because all the hedge funds had these margin calls, they had to sell their most liquid stuff. And so they were selling their large cap value stocks. And then we had a muni arb fund blow up. So this is like my first exposure to alts. You would think this would have scarred me for life and I would never touch alts ever again. But alas, it was the exact opposite experience. I actually got really interested in alts because this was all happening before the actual meltdown in the market. So I was like, whoa, something bad's coming. Like, I always like to say they're the canaries in the coal mine. If you pay attention to alts, you can see things happening in the underlying markets well before the broader markets see it. I don't care if you invest, you should pay attention because they most certainly are where the pain gets felt first, by far and away. But the other thing I started to learn when I was there was like, these are really cool products that are super diversifiers. And I had come from the long only like hedge funds are evil side of the world prior to that. So I had been completely brainwashed and thought like, these are just evil Wall Street guys that make billions of dollars and hurt other people. And I learned really quickly that that wasn't the case at all. And so it actually opened my eyes and I fell in love with alternatives by watching them implode. So maybe that tells you more about me as a person than anything. But it was that experience that generated my love for alts was watching what was happening in them at a time where it kind of helped me understand what the market was going to do next. I remember I put my dad all in cash that December. He was not retired at the time and he let me like manage his 457 plan. And I was like, Dad, I'm going to put you all in cash. He's like, why would you do that? I'm like, I don't know. Something doesn't feel right. I'm just going to. And then like the market didn't actually start to tank until after, well, it was really Lehman that the market just absolutely, but bear was like March, right? So I put him in December and he was mad at me for a while, but.
So Shana, what leads you to the conclusion about an alt to that it's a good one in that, you know, I'm the guy who always talks about how structure matters. Mm-hmm. Is it math? Is it a gut call? Is it a basic need that there's a problem out there? Right? What leads you to the conclusion that an alt is a good alternative?
So I look at a bunch of different things, but the first thing I always say is that I don't mind passing on something that ends up being good if I always avoid, if my work makes me have a much better batting average in avoiding the bad ones. So sometimes I'm wrong on I think something's bad and it's not, but I never miss the real problem children. And again, Madoff was my opening to that because we did work at Russell on Madoff and we passed, we used the alpha, what is it? Is it called the alpha tool? I think this was called in FactSet to like do like return decomposition on Madoff and we couldn't make sense of it. So we were like, something doesn't seem right here. So there's a couple of things. There's that, like, I always am super leery of something that is consistently really good more than I am of something that's consistently really bad. And my number one piece of advice, if anything, is like, if it seems too good to be true, it really probably is. And so I spend a lot more time being critical on the stuff that have amazing track records, like kill it all the time, never have a bad year, than on anything else. I'm much more critical of those guys. So those guys are automatic red flags. I start to figure out, I spend a lot of time when a fund looks really good, has really good track record, really good performance, really consistent performance. You know, it may very well be that this is just a super talented manager, but I need to understand because that's not how it works. Like even the best managers fail miserably at some point. They get it wrong. So that's the number one thing. Anything that's track record is too consistent, like always the same 2%, you know, even if it's not a sexy return, like Madoff is a perfect example of this, is like
Yeah. So too good
Never
to be
that
true, you
great.
stay away from. Too good to
Yes.
be true, you stay away. Okay.
Yeah.
What,
I
what,
also look for other things. I look at the operational back office. Do they have a known custodian, a known TPA, a known accountant, who's their legal team? And then I do a little due diligence. In the hedge fund world, we actually will do a background check on the manager. When I started in the business, this is awful to say, my senior analysts and the senior PMs used to have me go out at conferences to like the social events and see how managers interacted with me. Because if they were married and were hitting on me aggressively, like that was automatically getting them taken off the list. This was like, I was bait. It was awful, but I was like 27 at the time. So, but yeah,
Good.
that was another thing we did, because you're much more likely to have issues with a manager that has like, you know, some issues with like personal decisions and like just, you know, that kind of thing. So we would eliminate those
Core
guys.
risk management skills.
So we
No, this is actually a real ESG factor.
yeah,
Right?
so
Like that's no, seriously.
It is. No, it is.
right,
If there were pigs, you
Yeah.
didn't invest in them.
right.
Well, no, because it's a real risk because they're eventually going to get themselves in trouble doing something stupid. Like,
Right.
yeah,
good.
worse than stupid. Like, stupid's not even the right word, right?
It's
Like,
so funny. Everything I'm talking about right now are not like the things you would expect me to talk about. Like I didn't talk to the risk, you know, the head of risk, like the trading team. Like that's like so far past. Like you can actually eliminate the need to even go there by using these simple strategies first. You know, I always look at the hedge language at the bottom of your marketing deck. So if you have like a track record where you were doing back testing and then at the bottom it's like, this doesn't include trading fees. Our trading fees are blah, blah, blah. And it's like, well, then that's not a real back test. And there's all sorts of hedge language that's like very clearly showing me that like, that's not really an accurate description of what you're doing. So that's another thing. I want to look at who's invested in the private market. I want to know who else is invested with me. Because if I got a lot of people that come from the same space, they all behave the same. So they all run for the doors at the same time. And so I want to see diversification in the underlying investor base. I want to see some pensions, endowments, high net worth people, maybe a few sovereign funds. But I don't want to see only pension funds or only sovereign funds. Now you don't have mix of investor diversification, and all of those investors have different behavioral characteristics. And so you get everybody running for the doors at the same time, which is bad. That a lot of funds in 07, 08 blew up, not because they did anything wrong or their strategies underperformed, but because they didn't have diversification of their underlying investor base and everybody ran at the same time. That's what happened at Russell. We only invested, our only investors were Japanese pension funds. Blew up. So that's another thing I look for. And then you get into like the traditional stuff. I'm going to go sit down with the team. I want to meet everybody. I want to walk through the process. I want to do some like risk assessment using Barra or Axioma, pick your poison, to try to understand the factors that are driving returns. Like, do they match what the managers say? Are we speaking the same language? One of the things I like to tell managers all the time is make sure you understand the tools that the people who are doing their due diligence on you are using. Because if you start talking about leverage and you mean one thing, but the definition that's being used in their tool is different, then you automatically are not, you're talking past each other. Because you're going to say, I look for low leverage companies, but you're talking about, debt to equity. And the tool they're using is looking at like debt to cash flow. And so their tool makes it look like you have lots of high leverage, but you don't think you do. So now you're talking past each other and it looks bad. Understanding that is really important. So then I'm going to do the normal stuff. I'm going to have an RFP. I'm going to check out, the compliance reporting. How do you handle trade errors, account openings? How do you calculate your price? Like, then I'm going to worry about the stuff that, we all would do with any manager. But in the private world, all those other things for me, they cull the herd real quick. And you actually don't end up wasting your time going and doing all that deep dive work into the strategy because you can eliminate most of the trash just with those simple rules.
So it sounds like blockchain research too, Dan. Hey, before we're getting close to the wrap up, I do want to welcome a new person to our team. Dan Santiago is here. He just joined our firm. We like to say welcome whenever we got a new folks in. He's in our wholesaling team and the research team over there. So we're excited to have him. Shana, this has been awesome. I've really enjoyed this. I'm sorry I've been missing for a couple weeks, folks, but I'm glad to be back. I don't know, Dan, Cynthia, David, anything else to want to wrap it up? I have been putting the contact info and Shana's website in the chat if anybody wants to reach out. I don't know, take it from
Yeah,
there,
no,
folks.
I just say they don't call you the queen of alts for no reason, which Banrian means queen, in case you guys didn't know. We just learned that before the call. So
It does.
it
It means queen in Gaelic because I'm not creative and I used to do pageants and I just put it into a translator, and my mom's from Ireland. So that's where that came from. Yeah, any advisors that are interested in talking to me about kind of the work I'm doing, and anybody who's going to Carson Excel in a couple weeks. I'm going to be at Carson Excel. Would love to connect with anybody who might be there to discuss the work that I'm doing, the work they're doing in the alt space, and definitely some of the turnkey solutions that I now have through the partnership with Third Wire.
And I would add also, a lot of folks, some of you are in the audience, don't really know what we do in the ETF think tank. Feel free to reach out to me so I can explain further, how we help financial advisors do due diligence on alternatives like Shana does, as well as, build better portfolios in general. Thank you, everybody. We do appreciate your time and hope you'll continue the dialogue. Due diligence is an ongoing sport. Shana, you're awesome. Thanks very much.
Pleasure to be here.
Bye-bye.
Bye.
Thanks, everybody.
Thanks,
Bye.
team.